Welcome back, ladies and gentlemen. Today we have the pleasure to be joined yet again by Lior Gauntz, the Chief Executive Officer of Wealth Research Group. The guys invest in millions. We've come on, we've talked about stocks and so much more in between, but we're kind of sitting in these really intriguing, tumultuous times where I think it'll be fun to kind of pick your brain about going over just the multitude of sectors and exactly what's going on. But first and foremost, thanks so much for coming back on, man.
Yeah, absolutely.
It's always a pleasure to get you here. So, like I said, last time we talked a lot about individual stocks, but I want to kind of just talk about some of these upcoming events. First and foremost, I mean, there's been so much fear compounded on fear driving the market down. And I keep telling people, the idea of cost averaging is so important because we never know when the bottom's going to be. And considering we're kind of coming up to this earnings period, you have a lot of people like Michael Burry that are predicting we're still going to see a lot of potential downside because we're going to start seeing the earnings compression. Do you think in this current environment, even though the jobs market's so strong, that earnings are going to come out weak and we're going to see continued downside in the markets?
I think we're going to have something a little weird where good earnings will be punished, whereas weak earnings will be rewarded. And I'll explain. Um, the markets are really trying to balance when the Fed will win the fight against inflation. And part of this equation is, are earnings strong or not, and are earnings inflated or not? In other words, if earnings have still not come down and we're still facing 2 or 3 or 4 quarters more of weakening earnings, then every good earning is just another reason to sell into it because the Fed will continue to feel like the economy is robust enough, resilient enough to handle more rate hikes. And for the Fed, the reason they are raising rates is because they want more tools in their toolbox later on. They're just trying to front load as many rate hikes as possible um, into an environment that is clearly we're clearly slowing down, and we might even be in a recession, but we'll know on September 30th when the GDP numbers are out. So, in my opinion, in this earnings season, if it's strong, then you'll actually see more selling into this strength. And if it's weak, then it will show that the Fed can start to ease on its policies. And actually, the reverse will happen. You'll have weak earnings, and you'll start seeing some companies getting revalued for a recovery instead of for more weakness. So the markets, they started to price in a recession in November of 2021. That's when we peaked on the Nasdaq, and for the S&P 500, we peaked on January 4th of 2022. So the markets are already pricing in a recession for 2 quarters or more. That's a substantial amount of time. We are in a valuation reset. That's what we are in. We've lived in a world where for 13 years, from 2007 until about 2020, and maybe even until 2022, the scare was that we deflate, and therefore central banks kept injecting more credit and lowering interest rates, and it didn't create inflation. In other words, the markets and the growth and the innovation and the technology were able to absorb all of that debt and grow an economy. And right now, we're in the exact opposite. So everything that you felt and smelled and invested in for 13 years is now getting repriced for a new environment where interest rates are real, where valuation for future growth is less of a burning issue for investors, and they care more about the bottom line in today. And everything is getting remolded for this environment. Does it mean that some companies' earnings will get weaker just because of that? No, but it means that their earnings will be priced for less of a premium. That's exactly what we're seeing right now. So we're trying to figure out where that balance is, and that's where you come in with what you said, which is to dollar cost average. Because over the long term, if the companies that you invest in continue to grow and continue to be healthy, then all you're doing is you're buying more shares in a company that in the future will get out of this valuation reset and into some sort of a new normal and a new valuation um, consensus.
Yeah, I think we're personally, I think we're warming up for a bull market just based off the technological advancements. But from the inflationary standpoint, it's going to be intriguing to see what the next inflation data is because I personally think it's peaked, considering it was mostly driven by energy and oil. But what are your thoughts there? You think we're going to see inflation start to cool off and the Fed become more accommodative toward the second half of the year?
Uh, I I do think that um, the problem that the Fed has is that when they raise interest rates, they basically just created a financial recession. Anyone that has a lot of money in the stock market is in a recession. Potentially between retirees that own the majority in stocks and bonds, and more speculator, venture capitalist types, people have lost 20 to 30 to 40% of what they have invested, realized or not. That depends on the individual, but you are already feeling the recession. Real businesses or small businesses, mid-sized businesses, what they're feeling is not a recession. They're feeling the inflation in the real world, where they have problems hiring people, and then they have to pay more for those people. So you're seeing this whole opening up of the economy out of what we've had for the past 2 years, which is these healthcare restrictions, becoming very much like a jungle. And in some areas, it's more of a jungle, in some areas less. And then you compound that with the fact that we're no longer in a globalized world. China has their own agenda. Russia has its own agenda. Europe has a different agenda. The US has a different agenda. So we're no longer operating in sync, and that is obviously hurting this whole supply chain. So the Fed can keep raising rates. It can keep creating this bad environment for stocks and bonds, and can influence mortgage originators to think twice before taking out a loan. But it doesn't really solve some of the biggest problems that we have, which is energy prices, and then supply chains have nothing to do with the Federal Reserve. It cannot change supply chains. And worker shortages. The Federal Reserve doesn't directly help bring more workers back into the workforce. It does it indirectly by creating an environment that's stable. If people feel like, hey, inflation has been taken care of, then I feel safe going back to work now that I know that this economy is in a recovery. So it indirectly does that. But the problem that Jerome Powell's had is for the duration of 2021, he waited on Washington to do some regulations or less regulations, to do some taxation incentives, other incentives, to help the ports, to help the municipalities, to allow more housing permits because there's a shortage of housing in America, to help with the supply chain, for lumber and everything else. But the government didn't do anything. So while he was saying this is transitory, this is transitory, this is transitory, he was basically saying, I think the government will help us. I think the government will help us. But everything was hinged on the BBB plan that didn't work out. And he had to change his whole stance and become very aggressive with interest rate policies in November. So I think we're at the same point. The government is really failing to deliver imaginative and creative ideas on how to solve many things. And you cannot solve this just with monetary policy. You have to solve it with fiscal policy, and we're not seeing it. So I do think we're in for a longer period here of churning, where it's going to take a while for businesses to understand how to evolve, for investors to understand what the real risk in the economy is. So in my personal opinion, we're going to be at these levels and just trading sideways, and everything will feel like it's between recession and a recovery for a very long time. I don't see us getting into this, decapitation at the end, where we're going to see another 20 or 30% down for the big indices. What I think will happen is we will just churn for a very long time, and it might be like 4 or 5 years before we get back into these all-time highs with the indices. I think individual stock picking is it's going to be much better than the indices. Think about this: for 13 years, the Nasdaq has compounded at about 14% per year. Any hedge fund manager on Wall Street that delivers 14% per year for 13 years is a billionaire by definition. So buying and holding the Nasdaq was almost better than anything else you can do throughout the last decade, and that's unusual for the indices to beat so handily individual stocks. And I think in this environment that we're getting into, it's going to be the other way around.